All right, welcome back to the Million Dollar Portfolio. Today is Thursday, August 17th, 2023, and I have a pretty big update. I'm back into the market 100% as of today. So some trades have executed and things are pretty much in place. So yeah, I'm back in. But what a day to decide to go back in. And in reality, it's been over the last week or so. So it's not just today, but today was certainly interesting. So let's go take a look at the computer and see where we are. So right now, as of market close, the portfolio is sitting at $950,400. That's down like 36, 37,000 from the last month's update. So that's what, 3.6, 3.7%? Yeah, August has not been kind to the markets in general. And the last week and a half or so has been especially pretty brutal. But you know, if the markets are going down, it's the time you want to move back in. So I've been talking about going back in for some time now, and this is it. So this is what the portfolio looks like. We're actually sitting at 56% in the QQQ, and the gold holding is down to just under 10%, but everything else is roughly where it should be. So in terms of the actual allocation of the portfolio itself, it's 56% in equities, which is all in the NASDAQ 100, the QQQ. The 25% long-term bonds. We have 9% in gold, 10% in REIT, and pretty much 0% in cash. So I guess some actions over the next couple of months is to pare back the equities a little bit, get that gold holding up to 15%, like our allocation says, and kind of let it ride. How do I feel about everything? Actually, I feel pretty decent, but it's interesting to me because it's taking quite a bit to get back to what I call zero, right? To get back to where I started when I made this portfolio public, which is $1 million. So it's yeah, we're not quite there yet. And last month it was so close I could taste it, but not yet. The other thing that is happening is that next month historically is a pretty bad month for the stock market, September in general. Although, given what we've seen so far in August, we'll see how that goes. But September also has another Federal Reserve meeting where they could possibly raise rates again. Who knows? We'll see what happens. So there's a lot of market activity there. But I don't feel that bad. I think that I'd love to get back to zero, right? This has been one of those drawdowns for the last whatever months. And in fact, let's go into the portfolio visualizer just so I can show you what I'm talking about. So if I were to put in our portfolio and show you the drawdowns, this last period has been especially kind of difficult for this portfolio. But we'll compare it to a 60-40 portfolio as well and see how that shakes out. So let's go ahead and just do that. So 50, 25, 15, and 10, and then 60-40. All right. This only goes back to 2008 because of the BND. So let me switch it to the mutual fund version so we can go back to like 2004 or something like that, because I know that that's restricted by the gold shares. So okay, that's fine. So the reason that I picked the allocation I have, which I talked about in the allocation video, which I'll link down below, is that this gives me a pretty decent compounded annual growth rate for a pretty decent drawdown on the maximum, right? And when you compare that to the 60-40 portfolio, it's better. And if you were in 100% stocks, it would be like, max drawdown of 51%, meaning that your portfolio could go down by more than half. you know, at the worst. And if I put that in 100% stocks, you can kind of see that. So there you go, 51%. But what does this actually mean, right? If you were to look at this visual portfolio visualizer tool here and go to the drawdown tabs, basically it tells you that we're still in drawdown, right? The drawdown started at the end of 21, pretty much right on December 31st, 21, and it's been in decline ever since. Now, this year it has tried to recover, but when you're looking at this chart, you're not back to zero yet. I mean, we're getting there, but we're not back to zero. My portfolio is number 1, and it's it's still below. It's still in drawdown, right? And when we go down to the drawdown for portfolio 1, I guess it said that it started in, let me see here, where's that latest one? I guess this is it right here. So they claim that it starts in January of 2022. Okay, so that's right after that December close of 21. And it technically ended in September of 2022 because this is when it went down and then it made the corner and it turned back up. But we haven't recovered yet, right? So we're still going. So this is why the recovery time is still blank. And in fact, this is the worst drawdown over the last, whatever number of years that we've had. So there you go. That's drawdown, and I'm not back to zero yet. What's the other thing that I'm thinking about? Well, the other thing that I'm thinking about is that I think eventually, and I'll go into a deeper dive on this one in another video, but eventually I think I'm going to switch this Realty Income Core holding out for an ETF. I've done a lot of thinking about it, a lot of research and testing, and I think this is going to be the right move. What it's going to show is that you get roughly the same returns and roughly the same drawdowns, but it's going to be a little bit less risk, just because it's an ETF and not just one company. But that'll be down the road. So stay tuned, and I'll be right here with more updates as we go along. So once again, thanks for watching. I'll see you in the next video. Later.